Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is our podcast, episode 54, VideoCast, episode 64, for the week ending January 8th, 2021. So as always, we're going to start with some of our media spots where we can go through a lot of information in a short amount of time. I'd like to thank Liz Clayman and Jacqueline D'Ambrosi Scales for having me on the Clayman Countdown on Monday. And I was on just as the market was making its lows. I think the Dow was down around 500 points or so. And this is exactly what we were talking about in last week's podcast, VideoCast, that it was likely we were going to get some type of fake out where all the people who bought that tail risk, if you recall, that we looked at with the CBOE skew index, people buying very, very expensive tail risk, were going to feel like they were going to get paid, and then Lucy was going to take the football away from Charlie Brown once again. And that's exactly what happened. So Liz asked, what's going on? And I said, well, is this a shakeout or a fake out? I think it's a fake out. And the market was down on, election jitters, etc. But what's interesting is it turned out that which was feared the most was ineffectively well received by the market due to the stimulus. Also, we discussed kind of the outlook moving forward with the November-December up 10%. Ryan Dietrich had put out a post a week ago. What does that forebode for the markets? And it's actually positive. The average since World War II, when you have that type of year-end rally, is up 3% in January and up 18.1% for the full year, which would be really, really positive for 2021 after what turned out to be a pretty good year in 2020. So that doesn't preclude, your normal average intra-year drawdown can be as around 14%. I'm not sure that we'll see quite that much this year after coming off such a big drawdown in 2020. But, getting to mid-teens by the end of the year is a reasonable expectation. And then the other aspect that I covered with Liz was that upward earnings revisions. It's very rare to have. They've basically went up, most weeks of the last 12 weeks of the year. And when that happens, the average 3-month performance which would be Q1 2021 is plus 4.43%, and the quarter finishes positive 85% of the time. So a lot of tailwinds. Now, we're not oblivious to the froth, and we'll discuss that in this podcast as we did in the article over the midweek. But I said to Liz, the theme of this year is going to be the last shall be first. So the suggestion was to trim some of the stay-at-home and tech and growth and continue to add to the reopening and value and cyclicals on weakness. And the positioning we're seeing is changing dramatically among managers. So the weights are changing, slowly shifting. You're seeing in the investment surveys consistently now managers are starting to reposition out of what's worked the last 2+ years and into what's going to work, which we believe are going to be value and cyclicals. And then we put out our top 4 picks for the year. Now, some of these are carryovers from last year that have already started to work, and some of them are new. But the top 4 picks for 2021, Wells Fargo, Raytheon, ExxonMobil, and Walgreens Boots Alliance. It's interesting, how much flack I took for Wells Fargo, last year. No one believed it. Banks are, who needs all these buildings and pens with chains and different things, that banks would never work. And, now Wells Fargo is up close to 70% off its lows. I think we're just getting started here. Wells has some room to run. Financials have been taking up earnings estimates. We're going to talk about that at the end of this podcast. So we like continued strength in Wells Fargo. We like defense stocks. Obviously, Raytheon is a bellwether there. So Raytheon was our second pick. ExxonMobil's also had a huge run now, but we think that has continued strength looking out 12 to 18 months. And Walgreens Boots Alliance, another hated stock, that's starting to get a bid. They actually the We said that on Monday, and here we are on Friday. Thursday, they reported earnings, beat expectations, and the stock's up pretty meaningfully this week. So those are the top 4 picks. And, in the scheme of that transition that we're talking about, and it's not going to be entirely zero sum. So if you want to move forward and have no exposure to tech, you're going to get left behind. But on a relative outperformance, if you've been underweight because the indices are very low weights in the value and cyclicals, and that's going to start to change, this is kind of what we have to look forward to. If you take a look at this chart, this is a long-term chart of value versus growth. And, if you think you kind of missed these moves in banks and banks, financials, energy that we've been pounding the table on, and yeah, some of them are up 50 and 70% now in the last couple of months, but take a look contextually at how far we have to go. We're just making this turn as we were in late 2000 rather, right now. So there's tremendous opportunity. And if and when we do get some consolidation to digest the big gains or weakness in the Q1 or early Q2, that would be probably one of your last great opportunities to get meaningful exposure on the value and cyclicals if you've missed the first huge leg up. But this really just can give you some context of the potential moving forward. Taking a look at history. So this gives you an idea of what's been happening so far this year. This was CNBC just from today. I think it'll come to me who was talking. Bob Pisani was talking about this, either Bob Pisani or Mike Santoli. But Russell's small caps are up 5% year to date. It's January 8th, so we're 5 sessions in. Russell's up 5%. S&P's up 1%. Energy is up 9%, which is really exciting, and value's up 2%. So it's dramatically outperforming everything that we spent the last 3 to 6 months about talking on this podcast and VideoCast is really playing out. So that's positive to see. So now we start to have to look for where's the puck going next, because we'll hold what we have, and that's doing great. We'll add on any weakness, but we'll start to look at what's next. So Walgreens shares rise after earnings top estimates fueled by higher drug sales. So that was good to see. And don't forget, you've got the whole Boots Alliance part in the UK that's going to start to recover as more and more people get vaccinated and they get back to business. So a lot of promising things happening, I think, for Walgreens, which is one of the dogs of the Dow, by the way, and a nice dividend to boot. So also want to thank, first off, thanks again to Liz and to Jacqueline D'Ambrosi Scales over at Fox Business, and want to thank Medising and Shivani Kumarasan for putting me in their Reuters article earlier this week. I said a lot of people that may have missed out or sold at the wrong time last year are now saying, I want to get in. The coast is clear, the vaccines are coming, and they want to start to participate in the market. And it's just a question of state governments now picking up the pace of vaccine administration. So, yeah, and I do think, there have been so many people looking for a correction since late November, early December, and I kept saying later, let's, this thing's got legs. And, now you are starting to see some of the reluctant money forced in. I think that President-elect Biden's announcement today that, which you can see here, he's demanding trillions of dollars in aid as U.S. jobs drop. U.S. jobs are temporarily down. We'll talk about the jobs report today. We can bring it up right now. So basically what you saw here was non-farm payrolls dropped 140,000 relative to plus 71,000 expectations and plus 336 last print. And but yesterday you saw continuing claims, which is the most important number to watch, continue to come down. So expectations were 5.2 million. It dropped to 5.07. So that's all moving in the right direction. A lot of this is regional based on the shutdowns and the recent spikes, which seem to be plateauing. So I think it's temporary. But if it's a catalyst for more stimulus, the market's not going to argue with it. It's going to listen to them. And that's exactly what it did. So So he's looking for trillions of dollars. He's looking for $2,000 checks. Market was down midday because Senator Manchin said he wasn't sure, and then the market dropped 200 points, and then he came back and said, well, he's not sure that he's not sure, and then the market rose, and then obviously we had President-elect Biden come out and really take the bazooka out and say, we want big checks, we want money for business, and he said it's going to be trillions and trillions of dollars. So anyone's minimum wage at $15 minimum. So that's happening, and guess what? The bond market responded accordingly. After the blue wave, you saw 10-year yield break out. It's up 21 basis points in the first 6 days of the year, and to new levels. And if you remember last year on our podcast, when the 10-year was at 53 basis points and everyone was out saying it was going to 25 basis points, we said by the end of the year we could see it up at 100 basis points, which was so non-consensus. This was in the middle of the, basically the battle, and everyone's thinking negative yields, 25 basis points, etc. And we hit it, I think, 2 or 3 days later after the turn of the new year. So we closed the year at like 96 basis points. So that didn't happen. We didn't get to 100 basis points by the end of the year. But now we're at 110. And the market is clear that Biden is now, with the blue wave, not only going to ask for trillions, but he's going to get trillions, and that's going to be short-term stimulative for the economy, and the market's going to like that. So again, thank you to Mehta Singh and Shivani Kumarasan for including me. This is really the most important chart of the year. This has huge implications for banks in particular, which as you know, we love to spend a lot of time on that. And just keep an eye on this. This tells you the whole story. So moving into some news before we get down to the nitty gritty. The January Almanac. This is Yale Hirsch over at Jeff Hirsch. His dad started the Stock Traders Almanac decades ago. And it just basically does the mathematics, and it gives you a sense of what to expect in post-election years since January of 1950. The average return for the S&P 500 is 80 basis points, or slightly less than 1%. Tech tends to do better, 2.3%. That's pretty big. And the Dow about 60 basis points. So it's generally a positive time for the market. It's the 6th or 7th best month of the year, and that goes to show you. And with the Santa Claus rally coming to bear, that usually bodes well to January as well, in addition to the other statistics we talked about with positive earnings, upward earnings revisions, and the year-end rally tends to follow through for plus 3%. So a lot of tailwinds here, despite the froth, despite the skepticism, despite super valuations in pockets and speculative frenzies and some retail euphoria. We might have a little more gas in this tank before we take a breather, and we'll take it day by day. U.S. bankruptcy filings, get this, hit a 35-year low due to government pandemic aid. And this was data from Epic Acer that showed Chapter 11 filings used to reorganize larger businesses did jump 29% in 2020 to 7,100 and change from 5,100 in 2019. But overall filings, including all personal and other business bankruptcies for the year, were 529,000 versus 800,000 annually in recent years. And they were even triple that, 2.4 million at the end of the last recession. So to see this drop because of the stimulus is a very positive thing. And you are seeing it, the consumer is actually stronger than they've ever been. And that's reflected by credit card balances being very, very low, savings being very high, money markets being extremely high. The data is all there. And as they're coming out of the house, they're going to unleash that torrent of cash onto the economy. And we're going to see, and the market's obviously discounting a considerable portion of that, but there may be a lot more, especially with trillions more coming from the new administration and blank check to do it with the blue wave. So when you win, you get to do whatever you want. And that's exactly what happened. The Democrats won everything. It couldn't be a clearer sweep and a clearer message from the electorate that they want to see stimulus and they want to see spending. And that's exactly what they're going to get. So we saw here some confidence coming back from the consumer. Borrowing rose in November by the most in 5 months. This is a big thing because we want to see the consumer come back. And pulling up that data actually, yeah. So consumer credit was estimated to be $9 billion. It went to 15.27 versus 4.54 the last print. So this was a big expansion of consumer credit. So they're back in the game. They're coming out of their cocoons and they want to party. And that's why you've seen the articles about the Roaring 20s. I think you're going to see travel like you've never seen travel before. We're booking like crazy. And I think many other people are starting to think about the back half of the year, booking trips and doing that type of stuff. Although I was on a quick round, I had to go down to Palm Beach for a day. I was bidding on a property, and second property, and it was it's just unbelievable. Well, first off, the plane was packed to the brim. Everyone wearing masks. It's all good, but that's number one. Number two, the amount of heat in the market is unbelievable. This was a foreclosure, and I was outbid by $400,000. And I bid $150,000 more than what I thought was fair value, just because I liked it. And sure enough, I was just crushed. And what it told me is, like, not the time to play for a guy who likes value and likes opportunity. It needed some work, probably a few $100,000 of work, but good location, the whole thing. And I was just like, all right, this game is really too hot. And you're just seeing it. It's just trillions of dollars of global liquidity. So we stick to our knitting. We're going to stay in the market. And we think, continue to love banks, defense stocks, and energy. And with the really, huge hockey stick moves that we've seen in banks and defense from Q4 of last year to now, the greatest opportunity on a relative basis in the short term, I think, is in defense stocks, because they've got some weight to them. They've been trading heavy lately. We've been adding, and we think that's an opportunity. Obviously, we loaded up on banks and energy in Q3 and Q4, so we're really happy to see what's happening there. Would we be a fresh money buyer of banks and energy? Certainly in pockets, because they're going to have a secular run for time to come. Yields are just starting to go up. Housing demand is continuing. Energy demand, which is our next subject, is really just going to start to take off. And you had this huge gift from Saudi Arabia, which no one expected, because they're already cutting millions of barrels per day in line with their plan that goes all the way through April of 2022. And then they just added, Saudi Arabia just did another million of barrels of cuts per day, which has kept WTI above 50 just this week. And so that's really going to continue to be a tailwind for the larger players in the oil patch. And some of the smaller players will still continue to go bankrupt, but the bigger players will accrue share. And you're seeing this. BP is up 16% this year, Exxon 9%, Chevron 6%, Devon 18%, Occidental 19%. This is 5 trading days. So, it's just beginning on the one hand. On the other hand, it's like we've been talking about this for 2 quarters, and it's happening now. And what's also, which we pounded the table on in June with that Rystad chart, if you remember from the third week of June, I think we put that out in the podcast VideoCast, an article. We continue to get these draws every single week since, more or less. There have been a couple weeks where there have been builds, but look, this week, crude oil inventories, 8 million barrel draw versus 2 million barrel draw expectations. And seeing the plane full this week to get on that last minute flight, it was promising to see. And I think people are just going about their lives, and everyone's wearing masks. Some people are wearing the shields. That's a good thing. And the filters are great, and people are following the rules, and that's why it's working. So, okay. The other thing about oil, this was a great article by Jinju Lee at the Wall Street Journal today. And he said, peak oil, ? Drivers and voters could delay it for years. And the point that he's making is, BP said that, in the middle of the pandemic in March, when they were just panicked, they said, well, oil demand may have reached its apex in 2019. Well, obviously it came down relative to previous years, but they were just in the middle of war. Effectively, demand dropped off a cliff. We saw oil go negative, so naturally they're going to have that sentiment. But when you actually step back dispassionately, cooler heads are saying not only will it be the late 2030s, it might be a lot further, because the mechanisms that governments have to curtail use is taxes at the pump. And the case that Jinju is making is that drivers are voters. So if they go too aggressively with tax at the pump, what they're going to find is that they're going to have a hard time getting reelected. And especially you're seeing demand for SUVs. The other thing that you're seeing that he notes is that in all these governments in the emerging markets where they're putting emission standards on vehicles, all these vehicles are being then sold at a discount to developing markets like in Africa. So these higher emission cars are not going anywhere. They're just getting transferred to a different continent where demand is just starting to pick up. And that's why he's making the case that it's going to be much longer than people think, because to put these mechanisms in place, it requires the will of the people, and they're increasingly buying energy-thirsty SUVs in 2020. The car market was hot, and they were buying that. That's number one. Number two is he noted that the cost of fueling, the cost of fueling a car via electric versus fossil fuels, the electric average cost of electricity went up dramatically more than the average cost of fossil fuels or gasoline. And if that trend continues, the electric cars are going to be a harder sell. And then finally, he makes the case that, China removed their subsidies for electric vehicles in 2019, leading to a steep decline in sales. France announced a cutback on electric vehicle subsidies for future years, even as it plans to end sales of fossil fuel-powered cars by 2040. So these things are conflicting. It's the idealistic outlook of what they want to achieve and the practical output on what they could actually implement versus the voter demand for these different things. So that's basically it. But the cost of fueling right now, charging your car, the cost of fueling an electric car, what he's saying is 50% of fueling your car with fossil fuels. And that is narrowing, meaning electricity is generally going up while fossil fuels have been subdued. I think fossil fuels are actually going to have a run here over the next few years, and we've talked about that since oil went negative, basically, that over the next 12 to 18 months, get ready, you're going to see $3 at the pump, you're going to see $60 plus WTI. Well, now we're already, I think we hit 53 this week on WTI, so we're getting there well ahead of schedule. And I think that's actually going to help the electric vehicle and renewable sectors in the next few years as oil does get back up to $70 and you do see $3, $3.50, $4 at the pump. I think people are going to say, okay, let's see about getting solar panels. Let's see about getting that battery on the wall for intermittent storage. And let's see about getting an electric vehicle. And also the electric vehicle prices will be coming down. So particularly in the developed world, the thesis is correct. It probably just takes longer. And the catalyst may in fact be the short-term success of the fossil fuel industry, meaning prices go up dramatically for the commodity and margins for those companies, and that may very well be the last hurrah, and that's where EVs will really get their tailwind if you do see gas prices go up dramatically, and with the new administration likely curtailing drilling, they'll facilitate that with energy prices in the market going up high, and a potential demand from customers to get away from that because they don't want to pay the high gas prices if they can charge cheaper. Plus, you'll get more and more electric trucks. Americans like big SUVs. So, but I thought this was a really good non-consensus article that's realistic and not seeing the short term through rose-colored glasses. It is going to take time. It will happen eventually. That's probably a very good thing. But where we are and where we're going, and so highly recommend it. Again, peak oil drivers and voters could delay it for years. Jinju Lee over at the Wall Street Journal. Next, what's happening with Johnson & Johnson's COVID-19 vaccine? It's interesting. This is really positive because it's expected that they're going to apply. We could have data this month and get emergency approval authorization filing in early February. If we got data, this may be, a lot of institution. The guy who runs the Bank of America Global Fund Manager Survey over, interviewing 500 billion AUM of institutional managers. We cover that on every month when that comes out, the second week of the month. Had said the contrarian trade was to sell the vaccine. The vaccine rollout's been relatively slow. It's picking up pace. It looks like we're going to get to 1 million a day, plus the people who have been infected. We could have 60% of the population, 60% of the population with antibodies or vaccines by Q2, which gets us closer to herd immunity. Certainly, it'll bring the case count down dramatically, the death count dramatically. But I think that maybe this would be the sell the vaccine when this is finally announced at the end of January, early February, because this is a one-shot vaccine and it doesn't require the refrigerators that have made the logistics of the current vaccine so difficult, having to keep it at a certain coolness and then thawing it, and it's been complicated. They're doing the best they can, and it's accelerating, and they're getting it out. But I think a lot of people would really be in a rush to get a vaccine if it was a one and done. And when they announce that may very well be the peak of excitement in the short term, that we consolidate the gains for a while, get a nice healthy pullback, and then the back half of the year strong. So I'm watching that, and I think that's going to be just a great thing when that finally comes out. And you can get that done and get it out to millions. And they said they can have 1 billion for the world by the end of the year. So that's good news. In the short term, the Pfizer-BioNTech vaccine today, they said, will protect against the UK and South African strains they found in a lab. So that's good news that you're not going to have some mutation that's going to set us back 3 to 6 months. And now moving on to the article of the week, the Yogi Berra fork in the road, stock market and sentiment results. So he was not only a great baseball player, but a great humorist. And one of the quotes he was famous for was, when you come to a fork in the road, take it. So, we've spent the last few months building positions in banks, defense stocks, and energy. If you listened to or watched any of the podcast VideoCasts, it's been a broken record and an unpopular record at that until now. So now everyone's getting on board. Opinion follows trend, and that's a good thing. And the people getting on board, quote unquote, late, they're not late. It's just getting started. This is a secular trend. So they missed the first 30 to 50% in some stocks, but these things are going to keep going. over the next 12 to 24 months as cyclicals outperform in the first 8 quarters of a new business cycle historically. And we're just basically in the second quarter of the new business cycle. So that's a good thing. Now, the one thing that I didn't anticipate, we did talk about the vaccine announcement and the election as catalysts in October, and those certainly played out. I did not anticipate that there would be a blue wave that would be the secondary catalyst, as we've seen this week with banks and energy taking off after the election. But we'll take what we can get. I was joking. Anyway, if I'd known energy and bank stocks would have done this well, it might have changed my the way I voted. But nonetheless, it's a great thing for everyone. It's a new chapter, and it's going to be a very positive thing. And in last week's note, I said, so everyone looking for a kneecapping after the new year, I think it's more likely that the market pushes higher and forces a bunch of reluctant money that sold the March lows and have been waiting for their big correction that never came to get in. The more likely scenario is a crisis fake out or delayed result from the January 5th, 6th downside catalyst, in which the put buyers think they've scored, only to find a final push higher, forcing the final reluctant longs in before the trap door is finally opened. Best guess February timeframe, but who knows? So far that's playing out. We got a huge panic fake out on Monday where all the put buyers thought they were getting paid, and then we ripped higher. So we'll see how long this follows through. But my best guess is it might be to that J&J announcement when they release their phase 3 results towards the end of this month, or maybe it's the inauguration. Maybe people will just be a little nervous in the first few weeks until they see that, this is what I've seen so far as a centrist myself. The majority of the appointments have been pretty much right down the fairway, center of the road, starting with Janet Yellen at Treasury. You can't get any better than that. Many of the cabinet appointments have been just fine. So I think it's going to be very, very positive. So that's that. And okay, so that's that. We covered what we covered on Fox, and then the last shall be first. This is a key segment I want to cover. I touched on it with Liz Clayman on Fox Business. But what I put in the article was the quote from the book of Matthew reads as follows: "So the last shall be first, and the first last, for many be called, but few chosen." And my commentary was, even Jesus understood the importance of sector rotation. So let's get to it. Jurian Timmer of Fidelity Investments put out this table, which is basically every asset class and their performance by year since 1984, so 36 years. And I love these type of charts because when you actually study it, and I'm a mean reversion player, I like to look and see how asset classes move from out of favor to back in favor over time. And what you'll notice when you look at this, and you can find it at hedgefundtips.com, scroll down under popular articles, you'll see the Yogi Berra articles, the first one, and this chart from Fidelity comes up. And you're going to see that rarely can one asset class hold the top seat for more than a couple of years. And we're going to talk about it. So for instance, in the late 80s to early 90s, emerging markets held the top performance spot for a number of years, only to drop to the bottom over the next couple of years. So take a look here in the late 80s. So, 2 years in a row, 3 years. It went from 3 to 1 to 1, and it kept going. And then boom, by just a couple years later, it dropped. The next year, it dropped to third to worst. And the year after that, it dropped to the absolute worst performer. So here it was in 92. It was the best performer after a string of runs here for 3 or 4 years, dropped down to the worst just a year later in 1995. And, it stayed in the gutter for the next few years. Next was REITs had their run in the early 2000s only to plummet to the bottom spot. So you see here, REITs were, first they were at the bottom, 98, 99. They were third to last and second to last. Then they had 2 huge years. And sure enough, boom, they dropped to the bottom. So these things run in cycles. So what has been leading the way the last 4+ years is large cap growth. Was the number 2 spot for 17 and 18, the number 1 spot for 19 and 20. Every time in history you see, look, EAF, it was held the top spot in 1987. That's European. 85, 86, 87, and it dropped the next year, dropped more the following year, and got close to the bottom for the next 5 years. So this huge run you've seen in large cap growth, what's been at the bottom? Well, what's been at the bottom is small cap value, large cap value, and we're seeing that rotation already start to take place. They're going to probably move up to the top over the next couple of years. While large cap growth, I wouldn't be surprised within one of the next 3 years to see them in the bottom 3 spots at one point in time. Other examples, Japanese equities were the second to last performance in 96 and 97 after they blew up. And then, the following, they started to move up. And then by 99, they were the second best performing asset class coming from the bottom. And this just continues to repeat itself. So, if you can find reasons for things to turn, and they've been subdued for some time, also happened here in 90 and 92 when the bubble deflated. And then by 94, they were the second performance, Japanese equities again. So we're looking for what's left behind, small cap value and large cap value, and how quickly can they get back up to the 1 or 2 spot. And then the things that are consistently up here, they mean revert. That's just the nature of it. And you're going to see large cap growth start to relatively underperform relative to that. And that's also supported by this. Here's where we are. Value to growth, it's just turning, and that's going to be relative outperformance. Again, it's not either or. You still want to have some exposure to select names, and you don't want to go so abruptly. But the relative outperformance is going to be I believe small cap and large cap value, and that's what we've spent the last 2 quarters explaining. Next, Bespoke put out total returns for global asset classes recently, and keep your eye on the underperformers of 2020 becoming the outperformers in 2021 and 2022. So what were the big underperformers? Natural gas, oil, energy sector on balance, UK equities, and Brazil stand out as the last or the worst performers. They're already starting to turn. Can they move to the top of the list in coming years? I wouldn't count them out. So that's a good thing to see. We already talked about Santa came to town. The other thing is Ryan Dietrich over at LPL Financial, definitely worth a follow on Twitter, put out a Democratic sweep performance since 1951, when the Democrats held the presidency, the Senate, and the House. And the fact of the matter is, it is worse performance than when you have a split Congress, regardless of whether you have a Republican or Democratic president. If you have a split Congress, in both cases, whether it's a Democrat or Republican, it's the best possible scenario. The market does like gridlock because things can't turn on a dime. However, a blue wave or Democratic sweep, the average return since 1951 in those situations is 9.1% a year, which is not bad. So that's the outcome. And then you couple that in the short term with 2.3 trillion of CARES that, usually takes about 6 to 9 months to hit the system. However, most people have been in semi-quarantine, so it's just hitting their bank accounts. It hasn't circulated yet materially in the economy. Then we just threw another 900 billion on it, by the way, in case you weren't paying attention. So that's not even in the system yet. Never mind the 6 to 9 month lag. And now we're going to get a few trillion more. So if that's not the formula for some really rapid growth, I don't know what is. Last year in the midst of it all, we were talking about 5 or 6% GDP in 2021. I think that's going to hold true. And that's where we are. So nothing to fear but fear itself as a famous Democrat once said, in the context of the new theme moving forward in a Democrat-controlled environment. And when you win all three branches, you get to do whatever you want, and that's exactly what we're going to see. And we're going to see a tremendous amount of spending and stimulus. So that's what's happening. And the 10-year yield is telling you not only are they saying it, but they're going to be doing it. And that's where we are. So update on the Cobra Kai. If you recall, we put out this article, I think it was September 24th, when Wells Fargo was at $22 a share. It got up to, I think, 34 this week. And we were talking about the sentiment. This is a roadmap, and I can't find the source of this. This has circulated around Wall Street for probably decades. It just talks about the general sentiment as either a stock market or a single stock goes through returning confidence. Then you get enthusiasm/euphoria, and that's when you get the rollover that everyone ignores, and then you get panic, discouragement. That takes a long time to rebuild a base. Then you get the fake out like we got in May, and then you get long-term reversion before you start to head back up, get a little consolidation at denial. And the move from denial to returning confidence is the most abrupt, quick move in the entire process. And if you look at Wells Fargo, we just did this. Now, I did this chart, so again, you can just follow along. Enthusiasm to discouragement. We got the first fake out to anxiety. Our aversion was huge, multi-month aversion. And now we just got the rally up to denial where you get the consolidation. And we just broke out. And this was done on Wednesday night, actually, while I was on the plane. And now I think we're up between $33 and $34. So this period here could be very, very rapid. And the catalyst we have coming, by the way, may very well be earnings, results, and guidance. And maybe we'll see the reserve releases that I've been talking about. If you recall, the industry took $110 billion of loan loss reserves in Q1 and Q2 due to CECL, which was an accounting change that went into place at the exact wrong time in the middle of the crisis, which required them to take the worst case scenario of losses all up front, which they had to assume 20% unemployment when it was at 14.1%. It's no longer, not only did it not go to 20, it went down to, today we saw continued at 6.7%. So I think we're going to see a lot of reserve releases, which will be positive for earnings and certainly for guidance. So that's coming up this Friday, January 15th. Key thing to look forward to. The other thing, this was the chart from the Cobra Kai article in September, and we got the big sweep here down to 2025, and now we're up north of 33. So that just shows the 60-minute chart. And then here's the longer-term chart. If you think you missed it, think again. I mean, we showed many months ago that right around here, that 15 out of the last 16 times that this ADX crossed on a monthly chart, which, we don't use this kind of stuff a lot, but we couldn't understand why it wasn't returning. So you look at everything, and then all of a sudden it just flipped and held steady those returns. And we're just getting started here. You got a gap up at 35.36, and then book value around $40 a share. In the last two times that it traded below book, in the Great Financial Crisis and in the early 90s, it recovered to book, which currently is around $40 a share, within months, not years. And I think we're going to see the exact same thing this time, and we're getting very close. So that's really nice to see that play out. Okay, so this week, the sentiment was elevated. As a matter of fact, AAII, they posted the wrong sentiment on Thursday morning. They posted 42% bullish. That was wrong. It was actually 54%. It was a technical glitch they had. Fortunately, they tweeted out, and I was able to change it in the article. So it actually was 54. That's huge. I mean, that's euphoric levels. So that's why a lot of people are calling for crashes, because they look at 2018, January 2018, we got that level of euphoria. We crashed, it was over 10% for the S&P. And they say that has to happen. But we also got similar type reads after the election in 2016. That, I think, is a more realistic, a lot more things in common with that period. and you get this first spike, and then you get a move back up. We get the first spike. We got a huge move back up here. So this is, in my view, which is why I've been more bullish than most of the last 2 months, that it's probably more likely to follow. We had that huge drawdown in the early 2016, weakness into the election. Then we took off after the election. Same type of roadmap, but you do get some of this sideways consolidation. Now, if you recall, in 2017, we did not have more than a 3% drawdown at any point during the entire year. I think we'll probably get a little bit more than that. We should probably see a healthy pullback after we finally squeeze everyone in. And I think that's going to be, again, kind of optimism up to this new stimulus, up to the new administration, up to maybe that vaccine announcement with J&J, the single shot that's going to be widely available and will be easy to administer because it doesn't require refrigeration. And then probably that's when we cool for a little bit. And even in 2017, you saw looks like you peaked in March, and then you went sideways to down for about a month and a half before resuming the uptrend. You could see that type of thing in February, March, or maybe more. But I don't think it's going to be a 2018 like. And even if it is, it's not the end of the world. I mean, you got trillions in the system right now. You got the consumer just dying to spend their money and start traveling. And by the way, as far as the energy thesis, back to that Wall Street Journal article, that's a huge driver of demand is airlines and air travel, and that's going to come back roaring. I believe. I think people want to go to beaches and palm trees and blue water and that type of thing. So fear and greed was basically neutral at 60 at the time of this article. And National Association of Active Investment Managers came down a bit. Their equity exposure dropped. I think it's actually picked back up towards the end of the week. So they're kind of getting positioned for that last, move up here. I think that's going to finally draw everyone back in. And the article, my view for the week was the same. There's euphoria. I think the odds do favor a mid-Q1 pullback after most managers have given up on a correction and followed the chase. I think we're getting close to that now, and I think it'll probably be justified by the vaccine, justified by further trillions of stimulus. Everyone will get back into the market, and I think that's probably when we have to take a breather, for a month or two, and then pick back up in the back half. And I likened it to Wile E. Coyote running fast until he realized he's run a little too far and drops off the cliff. We're not dropping off of any type of cliff, but we are due for a pause after we move a bit higher here, I think. So that's the story here. We'll use any weakness that we do get in Q1 and Q2 to add more value and cyclical names to hold for the next 3 to 5 years. Why? Picture is worth 1,000 words. Back to the value to growth chart. I think this is just the beginning, and there's tremendous opportunity in those groups that we've been talking about: banks, energy, and defense stocks, defense and aerospace. So that's where we want to be overweight moving forward. Wells Fargo got yet another upgrade. Again, opinion follows trend. No one could downgrade it fast enough when it was at $22. Now they can't upgrade it fast enough at $34. They now upgraded to buy from hold with a price target of $38. Turnaround is nearing a positive rate of change in many parts of the franchise. Ooh, a positive rate of change. Okay, so that is good news. And he expects Wells Fargo to be one of the few banks to show declining expenses for the next few years. That deals with the efficiency ratio that we've been talking about for the last 4 months. Is, I think, 10 percentage points higher than its peers. So there's a huge amount of room to cut, and that's largely related to outside vendors. Charlie Scharf couldn't believe he'd never seen a business that had so many outside vendors. So that's where they're trimming a lot of the fat, and that'll be a good thing moving forward. The yield curve steepened even more this week. That's obviously positive for banks, and you see what happens historically when you get that steep and financials just take off. And financials are now taking off. So Good thing to see that happening. And it's not only the pictures that are valuable, but the words matter too. This is from FactSet talking about financials earnings. JP Morgan Chase leads earnings increase since September 30th. The financial sector has recorded the largest decrease in its expected earnings decline of all 11 sectors. That's a double negative, decrease of the decline. It means it's improving. So it went from negative 7.5% year on year for Q4 2020, by the way, which we're going to hear on Friday. From it was expected to be negative 24%. It's now only going to be negative 7.5%. The sector's also witnessed the second largest increase in price, 28.5% of all 11 sectors since September 30th. Overall, 54 of the 65 companies, 83% in the financial sector, have seen an increase in their mean EPS estimate during this time. So their estimates keep going up every week since September 30. Of these 54 companies, 28 have recorded an increase in their mean EPS estimate of more than 10%, led by Capital One Financial, Wells Fargo, and then also they mentioned JP Morgan, Bank of America, Wells Fargo, Citigroup, Goldman Sachs, and Capital One have been the largest contributors to the increase in expected earnings for this sector since September 30th. So that's great to see moving forward. And okay, moving right along to earnings. We did the Dow 30 stocks plus 10 stocks in the S&P that were not either in the Dow or the NASDAQ 100. And in the last 60 days, these 40 stocks have increased earnings estimates cumulatively by 63 basis points for 2021. So that was good to see. Earnings are up for all 40. And we did and that's that. And then some economic data for this week. We've covered a number of points. Obviously, consumer credit was nice to see today. The unemployment rate staying at 6.7% was good. As those regions reopen, I think this non-farm payrolls is going to be a non-issue, but the stimulus is going to help. The other thing that we saw, which is critical, is average hourly earnings ripped higher to 5.1%. The reason that is that private business is now competing with the government. They have to pay their workers a lot more in order to get these people to come back to work, because between the unemployment plus the extra $300 a week, many people are making more money at home than they would going back to a lower paying job. So in order for employers to get the workers that they need, they've had to raise wages. And I think that's going to be sticky moving forward. And with the new administration and Congress, I think they're going to push for a higher minimum wage. I think that will persist. And that's going to be part of the inflation cocktail moving forward, in addition with massive borrowing and stimulus. So keep your eye on wage inflation. Average hourly earnings were up 0.8%. Month on month we're up 0.8%. Year on year up 5.1% year on year. So that's good to see. ISM non-manufacturing crushed it. That was at 5.72 versus 57.2 versus 54.6 expectations. Also over 55.9 last print. Good to see. Non-manufacturing business activity was also beat 59.4 versus 55 estimates. As I said, continuing claims continue to come down. That was good to see. Huge draw in crude. Oh, what was the rig count? Rig counts went up. Okay. Oil rig count went up 8, and total rig count went up 9. That's pretty natural with the increase of prices. And let's see. Okay, the API, ISM manufacturing prices beat expectations. ISM manufacturing PMI came in at 60.7 versus 56.6 on Tuesday. So the data continues to improve largely. Construction spending was a little light on Monday, but not a dramatic, it missed by 10 basis points. And then earnings to look forward to next week. A couple home builders early in the week, but the key story is going to be on Friday. JP Morgan, Wells Fargo, Citigroup, and PNC are going to report. So pay close attention to that. And with that said, thanks for tuning in to our 54th podcast, 64th VideoCast. We'll be back next week, same time, same place. Thanks for listening in. Make it a great one.